Good afternoon, everyone. My name is Jack Minns, and I'm shortly going to present to you about how to confidentially sell your business. I'm just going to allow a couple of minutes for everyone to join and look to start in earnest at 2 minutes past the hour. Just a couple of housekeeping points to be aware of. If you are watching this inside a cloud environment like Citrix, sometimes the software works better outside of. So if you're able to view this outside, just copy and paste the link. And if you do have any problems throughout the webinar, please don't hesitate to raise a question in the question box. We've got technical people in the background that can help if needed. So I'll just wait for the all clear when we've got most of our attendees, and then we'll get started. Okay, looks like most of our attendees are here, so I will get us underway. So first of all, good afternoon, everyone, and welcome to this, our second webinar in a series of 3 webinars focused on selling your business in 2020 and beyond. Last week, James Lay, the partner in charge of our team, covered some valuable content on how you value a business, some top tips for growing business value and preparing for due diligence. If you didn't manage to catch this last week or would like to see it again, it was recorded and is available to view on our website, so I would encourage you to check this out. This time next week, we'll be moving on to the final part of our series, where we'll be talking about life post-deal completion, taxation matters, and I'm also delighted to say we'll be having a Q&A with a business owner who's been through the process with us. So if you haven't signed up to next week's webinar yet, then please do so. And likewise, if you know anyone else that might be interested, then please do let them know. Today, we're moving on to the second webinar, and my focus today is going to be on how you sell a business. And the context of my presentation will be largely focused around a trade sale. But before I start, just a brief bit about myself for those that don't know me. My name is Jack Minns, and I'm a director within the corporate finance team at MHA Larking Gowen. The term corporate finance doesn't necessarily mean a great deal to everyone. So to put it more simply, I assist clients primarily with transactional work, whether it's buying or selling companies, management buyouts, reorganizations, or standalone company valuation assignments. My contact details are on screen if you want to submit any queries confidentially. But one thing I should highlight is that today's webinar does have a confidential question facility. So on your toolbar, there is a place where you can submit any queries. These will only come through to me and will be completely redacted. So any questions submitted are confidential. But as I said, likewise, if you prefer to have a chat outside of today's session, then I'm more than happy to speak with you outside of this presentation, and my contact details will be available again on the final slide at the end. So in terms of today's agenda, the session is going to last around about an hour. I'm going to do a quick recap on typical exit options before moving on to the 11-stage sales process, and then we're going to finish with Q&A. So exit options, if you're thinking about your succession plans, first and foremost, you need to be aware of all the options available to you. Perhaps the most obvious and the focus for today's session would be a trade sale. So this would involve selling the business to perhaps a complementary business or competitor, or maybe an investor or private equity firm on a third-party arm's length basis. You could look at doing a management buyout. This is only really an option for you if you've got good second tier management in place. It does have some benefits in that you tend to have less of a intrusive due diligence process, as the management team in theory know everything about the business. The main drawback of an MBO compared to a trade sale tends to be that the price can be a little bit lower, and certainly from a funding perspective, there tends to be less consideration payable on day one, as most employees won't have access to significant capital. You could look at a management buy-in where expertise comes externally. This can be slightly more difficult than an MBO, but we've seen it done in practice. A fairly new exit option that's being utilised by lots of businesses now is something called an employee ownership trust. And this involves selling the business to the employees equally as a whole in a trust. And you must give control to the employees. So over 51% of the share capital has to be sold. And one of the key advantages of an EOT is that there's zero CGT to pay. So it is tax-free. Now, there are plenty of hoops to get through to get there, and I wouldn't encourage anyone to go down an employee ownership trust route if your sole purpose or rationale for that is to pay no tax. You really have to be dedicated to, if you like, almost gifting and looking after the welfare of the employees. So Richer Sounds on the high street became an employee ownership trust business very recently, and there have been some examples locally, such as the restaurant chain Arbuckles. That was one of the first employee ownership trusts utilised in the region. For significantly large businesses, flotation is a genuine exit option. If you're in a niche market where there's no natural buyers for your business, and you're one of the biggest in your marketplace, then listing on say the AIM list, for example, might be your only feasible exit option. And locally, we've seen this with the fishing distributor Angling Direct. A solvent liquidation could end up being an exit route if you've sold just the trade and assets of the company. You've been left with a company that's lots of cash in it. Going through a solvent liquidation process is a tax efficient way to distribute those proceeds, but generally this won't be the most well-trodden path for most businesses, as you're not likely to have a huge amount payable for goodwill and might be more suitable for something like a property development company, for example. And the final point I want to talk about, albeit it's not really an exit option because I'm talking about retention here, but if you can legitimately step back and extract yourself from business operations, it can be a really good way of achieving your future ambitions. So we did have a client that had a very good second tier management team, and they actually moved to Cyprus and kept receiving a great return from the business in terms of dividends, but they still held on to the shares, which from a tax planning perspective was very good because the shares qualified for business property relief in terms of their inheritance tax planning, and they were getting a really good income stream from those dividends, much better than you'd get in a return from the bank. So in some situations, retention may be a legitimate strategy, but my focus today for today's session is going to be around a trade sale. So at MHA Larking Gowen, we generally follow a 11-step sales process, and James covered steps 1 and 2, which we refer to as the sort of maximising value stage, in significant detail last week. So I'm not going to cover this content today, but as I mentioned, if you haven't seen this yet, then it is available on our website. So my focus is going to be on the sales process itself, and in earnest, this starts at stage 3 on our flowchart, which is the sales documentation phase. So you've made the decision you want to sell. How would we recommend you go about doing it? Well, first impressions really count. So you might have a little black book of contacts that you think might be interested in acquiring your business and think, well, I'll just send them a few years worth of accounts. That'll do, won't it? Well, no, not if you really want to attract top bids to table. You need to present the business in the best possible light and inform prospective buyers about the true underlying financials, inform them truly about how the business operates, and highlight its potential for the future. And at a high level, there are three key sales documents we use when we're approaching potential buyers for the business. We have something called the teaser, a non-disclosure agreement, which is also sometimes referred to as a confidentiality agreement, and an information memorandum. So before I talk about each of these documents, it's really important for me to highlight to you the importance we place on confidentiality. So confidentiality is absolutely key. You know, as business owners, I'm sure you'd be wary about your competitors or staff becoming aware that you are actively marketing the business for sale, as it could be destabilising to any of those parties. The truth is that probably every business is for sale at the right price, but it's not something that people openly talk about. But if you've made that decision to actively sell your business, then you'll want to ensure it's been handled as confidentially as possible, and therefore you'll see it throughout. As I talk through the process, we work very closely and carefully with clients to ensure you've got complete control over who's included in the process, and that only approved buyers that have signed the appropriate non-disclosure agreements would ever find out the identity of the business being sold. So this is something we take incredibly seriously, and it's important to highlight at the outset. It's at the heart of everything we do when we're selling businesses. So the first sales document I mentioned was something called the teaser document. So the teaser document, in summary, is like our hook that we use to establish if a prospective buyer would be interested in acquiring the business in question. It's prepared on a completely no-names basis and highlights the key attractions of the business without revealing its identity. We prepare the initial version of this document based on input from clients, but the final wording is signed off by you. And this document also provides us with our script when we're making our initial calls and correspondence with potential buyers. So only stuff that's in that approved teaser document is what we're going to be using to speak to people about the opportunity. And there's a really important balance to strike on the teaser. We need to ensure that there's enough information given to a prospective buyer to allow them to decide if it's something that looks of interest and they'd like to find out more. But at the same time, we don't want to pick it up and go, I know exactly who that is. So it is a fine line. So to try and help bring this to life a little bit, I've got an example teaser document here for a business we sold in February last year. All teaser documents include a brief description about the business and its activities. We'll have some key highlights and attractions, maybe future opportunities for growth, as buyers will want to know how value can be increased, along with key financials and contact details of those acting on the job, and maybe the reason for sale. As you'll see with this particular teaser document, our client didn't wish to disclose the detail about the location of their business. So in some situations, we might describe the business location as East Anglia, or perhaps even county specific, depending on the nature of the business. You'll also note here that the teaser is branded as MHA rather than MHA Larking Gowen, and I'll talk about our role in our national association MHA later. But again, this was used to disguise the identity of the business and where the approaches were coming from. But generally speaking, we always use a non-area code phone number. So we've got a 0330 number bespoke for corporate finance projects. And we can use project email addresses or MHA email addresses if there's any concerns about, a teaser document being branded up in MHA Larking Gowen branding. Now, one thing I would highlight is that no prospective buyer could have identified this business by reference to financial data. So this particular business was filing abbreviated accounts, which meant it didn't need to file its profit and loss account at Companies House. So even the most nosy buyer, if they get hold of this teaser, they couldn't have gone to the Companies House and tried to work out who it was. For larger businesses where profit and loss account data is on public record, then clearly would be a bit more careful about what financial data is included. We might use sort of ranges, or make sure we use round numbers where the numbers have been suitably adjusted, that you can't go and then track back to Companies House. So in summary, the teaser document is a really important approach tool that clients have complete control and sign off over. There's no right or wrong to this, but you've got to try and strike the right balance. And we have seen it in the past where perhaps we've taken too cautious an approach with the content of the teaser document, and prospective buyers saying we don't know enough about the business to know whether it's something we want to go forward with. And so if we need to tweak it as we go, that's something we can do. But as I say, important to strike a right balance between giving enough information but not effectively telling a potential buyer who it is. So the second key document that we would use as part of our approach work, and that gets sent with the teasers, is something called a non-disclosure agreement, which is also referred to as a confidentiality agreement. So what is an NDA? Well, it's a legal contract between at least two parties that outlines confidential material, knowledge, or information that's going to be shared between two parties for a certain purpose, and it restricts access to this information from third parties. Who prepares it? Well, generally we'd recommend that they're prepared by your corporate lawyers, but we've got some good templates that we've used in the past, and we're happy to share with clients where appropriate. We would recommend that your non-disclosure agreements are signed on a no-names basis, but contain reassignment clauses. So effectively, a prospective buyer signs the non-disclosure agreement with MHA Larking Gowen, but we have the rights to assign the rights under that contract to our clients. So at this stage, still, a prospective buyer does not know your identity as a seller. Are they enforceable? Generally speaking, NDAs probably act more as a deterrent than anything. They can be difficult to enforce, as in practice, you'd need to prove that an individual or organisation had breached confidentiality to their advantage, and for there to have been a quantifiable loss as a result of that breach. So they are difficult to enforce, but it does help weed out those that aren't necessarily serious about the opportunity. And how can my advisors help me? Well, we send those confidentiality agreements with the teaser for prospective buyers to sign if they're interested in receiving further information. And as I say, up to this point, the buyer still does not know the identity of the business, and therefore you've got complete control that a buyer will never find out who you are until they've signed that appropriate confidentiality agreement, and if they've been approved, which I'll come on to slightly later in the presentation. So that's the first two key documents, the teaser and the confidentiality agreement. The third and final sort of key sales document we use is something called the information memorandum. Now, the information memorandum, or IM as it's commonly referred to, is a comprehensive sales document that is only sent to approved buyers that have signed that confidentiality agreement. It's only at the stage of receiving the IM that your identity is revealed. And it's a really, really important document, as it does lay the company bare. It gives it's a full sales document that gives lots of detail about the business operations. And in theory, it should provide a prospective buyer with enough information to enable them to make an offer, and at the very least, at least ascertain if they're interested in doing so. And coming back to that first impressions point, you've only got one chance to present the business in the best possible light, and the information memorandum is a place to do that. A buyer's not going to go and do that for you. And we work on both sides of transactions, as I said at the outset, and we've seen plenty of off-market transactions that we've conducted on behalf of acquisitive clients, and this can sometimes lead to bargain purchases, as there's no IM setting out the true profits and potential of the business, no quantification of any cost savings or synergies, and perhaps most importantly, there's no competitive tension because there's no other bids at the table. So when we've seen it in the past where clients have received off-market approaches, our recommendation would be typically to prepare a short and snappy information memorandum for that potential acquirer, as it will help you put your best foot forward, let the buyer know you're taking the approach seriously, and actually keep the pencil sharp, because if they don't come in with a acceptable offer, you're ready to go to market if you so chose that that's something you want to go down. So I think the information memorandum is the key sales document in essence. Now, what's included in a typical information memorandum? Unfortunately, I can't show you an example like I could with the teaser, as I'd need to get all attendees of the webinar to sign a suitable confidentiality agreement, and I'd need to get you all approved to receive it from my client. And I'm not sure that you're all from different types of businesses. I'm sure there wouldn't be an example that was suitable. So to try and be helpful and give you some guidance over what would be typically included in information memorandum, it would typically include the following key headings. So deal process will include details of the deal team acting on the transaction. So all correspondence with potential acquirers would go through your advisors, allowing you to focus on running the business. There'll be details about document destruction procedures for any parties that withdraw from the process. And perhaps most importantly, there'll be details around the contents required of any indicative offers to be made. And we set these out pretty specifically to ensure that when it does come to reviewing offers at a later stage, offers can be more easily compared and contrasted, and it reduces misunderstanding on what's on offer and how it's being paid. You'll have an executive summary, so an extended 1 or 2 page summary with key highlights about the business operations and financials. There'll be a section around the business background and history, so brief timeline of the business and how it's got to where it is today. The business operations will be a really chunky part of the information memorandum. This is really setting out in layman's terms the company's areas of business and what it does. Where possible, we'll try and quantify, the revenue and profit contributions from different products or service groups. We want to provide details of what makes this company unique. Where appropriate, we might include some redacted detail around what contracts you've got in place, so give an idea of any recurring revenue, the spread of customer concentration and supplier base, again on a redacted basis. So, customer A, customer B, certainly wouldn't be giving away customer names or anything at this stage. And giving details about, what the company's unique selling points are, laying it in layman's terms to buyers what the company does. We'll look to provide some commentary on the marketplace the business is operating in. And you might say, well, Jack, why are you bothering with that? I assume you're just going to pick up the phone to my competitors and they'll know the marketplace we're operating in. Well, no, that's not who we're just going to be approaching, because we're going to be looking at complementary businesses. We're going to be having, high net worth individuals, perhaps private equity funds interested. They won't necessarily know your marketplace. So we need to be setting the scene to all potential buyers as to who the key competitors are, what's our market share compared to theirs, what's the size of the market and what opportunities are there for growth. Again, these sort of investor style buyers will want to see that there's potential to grow the business further. They won't necessarily want to see that you're at the top of the market and it's saturated, for example. Management and ownership. Clearly it's important to set out what it is that's for sale and who the shareholders and key decision makers are. We need to talk about what roles the current owners fill and share some redacted details about key second tier management and their role. Typically we'd like to include an anomalised company organisational chart, because this can help a buyer identify what gaps might there be once the owners have left, but also help them spot opportunities for resource sharing and economies of scale once the two businesses are combined. Business premises, obviously we need to let a buyer know about where the business does its business from, whether the properties are freehold or leasehold, and what terms might be available to a buyer. Future growth opportunities is a really important part of the information memorandum. What low-hanging fruit could a buyer go after immediately to deliver returns? And we tell clients to be quite, be open-minded here. There's not necessarily limitations. If money was no object, what would you do to grow the business over the next 5 to 10 years? Because this could be particularly relevant if, again, some sort of investor or private equity buyer was appropriate, as they'll want to know what further returns can they make if they deploy more capital. Could they go and consolidate the market? Are there complementary businesses that could be purchased? And is there maybe any industry or regulatory changes that are increasing demand? As you'd completely expect, there's going to be a detailed section on the financials. As James touched on his presentation last week, we need to demonstrate what the maintainable earnings are of the business to demonstrate the true profitability. So we need to adjust for any exceptional items, any one-off costs or non-market rate expenditure. And if we think there's growth, then forecasts are really, really important. You've got to go and demonstrate it and quantify it. A buyer won't just do it for you. So if you want growth value factored into a buyer's thinking, then forecasts are absolutely vital. And there may be other appendices that we include on each job on a case-by-case basis, like some photos of the site or regulatory press or accounts. But again, that fairly case-by-case basis, we can include whatever's felt appropriate in terms of furnishing with a prospective buyer with more information. So they're the typical contents of an information memorandum. But in addition to setting out the maintainable earnings on a standalone basis, we also use this key sales document to highlight and quantify the potential revenue synergies or cost savings that might be available on acquisition. So this goes to the principle that the sum of the combined parts is worth more than the business in isolation. So I'm an accountant, I know that 1 + 1 doesn't equal 3, but this is the idea we're trying to put into the buyer's mind. Actually putting these two businesses together, they'll be worth more than the individual components. So whilst the buyer might not accept everything that's put forward, it can certainly help increase their idea on the ongoing profitability and maybe lead them to increase the multiple they're prepared to pay. So what do I mean by synergies? Well, revenue synergies could be generated by having the ability to sell new products into existing customers and vice versa, as well as potentially having access to a wider geographic region, for example. Economies of scale tend to be focused on sort of cost savings that can be generated. So that could be through increased buying power or savings in rent or wages and things like that. And this really came to the forefront on a recent case, a business that we sold in August, where our chosen acquirer was both a customer and competitor to our client that was selling. There were clear economies of scale that could be generated as some goods were purchased at a better rate by our client and some by the buyer. They also bought a lot of the same raw materials, so putting their two buying power together would enable them to negotiate better rates with suppliers. There are also clear revenue synergies as the buyer had a really wide geographic footprint. So they sold direct to customers, whereas as our client only sold business to business. So this was massively helpful, both in generating significant deal value because there was a value attributed to synergies that was factored into the deal, but it also got real buy-in from both sides. So like the key directors and senior board at the purchaser could really see that buying our client's business would make them stronger. So it was also valuable when it came to negotiations and the due diligence process because they were just already totally invested in wanting to buy this business. So important to try and quantify and get value for synergies and economies of scale. So that was the 3 key sales documents we use. So just as a recap, it was a teaser, the NDA, and the information memorandum. At the same time that we're doing our sales documentation work, we also need to identify and profile potential acquirers. Now, you've probably not been paying any attention to the little quotes at the bottom of these slides so far, but this one's the one to check out because I found a great quote from a top advisor in relation to this, but it's something that rings really, really true. So your advisors can produce the best sales documentation in the world, but if they're not picking up the phone to the right individual at the right organization, then you as a client could miss out on the best deal available. And I'm sure many of you on this webinar might think you know who the most likely acquirer of your business is, but I suspect around 90% of you will be wrong. So you might think you know, but actually it could easily be someone you hadn't heard of before, or someone that didn't think would be interested in your sort of business, and that's where your advisor should be adding considerable value. So at MHA Larking Gowen, we identify buyers in two ways. We make direct approaches to businesses that we think would be appropriate buyers, and we also receive indirect approaches. So firstly, as you expect, we've got access to a wide range of corporate finance research tools to enable us to identify potential acquirers in the marketplace. We can clearly see who's acquisitive in your field, who the key players are, and who the key individuals are. And we use all the tools shown on this slide to help identify the right businesses and the right individuals at those businesses, as it's really important that approaches are made at a senior level. Most of the time we're approaching board members, and depending on the size of the business, some buyers will actually have dedicated individuals or teams that handle acquisitions for the company. So rooting out those key individuals is an important part of the buyer research. And when we're looking at buyers to profile, we're not just looking at competitors. We'll look at similar and complementary business as well. So we'll look up and down the supply chain to see if anyone would benefit from horizontal or vertical integration. And when we're presenting buyers to clients for approval, we'll provide a brief commentary as to why we've included them, and also a summary of their financials. So you want assurance that we're only going to approach those buyers that we think have got deep enough pockets to fund an acquisition at the anticipated deal level. So we do that due diligence for you on any buyer we put forward. So you've got confidence that actually if this business was to make me an offer, they can execute at that value. Where the business is suitable for private equity, so tends to be businesses making north of £500,000 EBITDA with lots of growth prospects, then we are well connected with all the PE firms and first name terms with those that look after the East Anglia region, so we can bring those buyers to the table very quickly. So this list of buyers that we're going to approach directly and actually pick up the phone to and proactively present the opportunity is agreed in advance of our clients. And so if there are any businesses that our clients don't want involved in the process, then these can be blacklisted, and we can ensure they never receive the teaser document and are excluded altogether. So in addition to the direct approaches that we'll go and make, we will receive what we would refer to as indirect approaches mainly from our network and contacts. So one of these sources of indirect approaches is our acquisition watching brief. We've got a register of over 100 generally acquisitive clients and contacts, which includes Larking Gowen clients and contacts, acquisitive parties we've done deals with in the past, as well as a lot of high net worth individuals and family investment companies. And this has been a really good source of buyers for quite a few of our transactions. We've sold quite a few businesses to companies on this list. I also mentioned earlier that MHA Larking Gowen is part of a national association called MHA, and this is an association of 8 independent accountancy firms operating all across the UK. Now, each of these member firms has got a corporate finance team, and we meet with these guys very regularly. I mean, at the moment it's obviously video conferencing, so we're all getting very adept on Microsoft Teams. But this gives us access to market intelligence on a national level, and it's actually a really great source of additional buyers on sales opportunities. So we share teaser documents across the association, and where MHA member firms have potential buyers, then obviously they can bring those to the table. MHA in turn plugs into Baker Tilly International, so this gives us access to international markets where the opportunities perhaps suitable for a cross-border transaction, and we have used this to good effect. So we sold a business to an American company, it's February last year, and we were able to do some background checks on the buyer first, utilizing our BTI network in America. So again, national and international reach, which is really, really useful. As you expect, we've also got a good network of other professional contacts and advisors that we can share opportunities with. And likewise, we've got access to carefully selected databases and websites that we can list the teaser information on if you're in an agreement for us to do so. And these third-party approaches can often help sweep up any other potential buyers that might not have been considered as part of the direct approach list. So sort of in summary, we use our research tools to identify a list of buyers that we'll directly approach because we think they really need to see this, that we agree with clients up front. But in addition to that, we will receive indirect approaches from third parties, from our network and acquisition watching brief, which when we receive NDAs back from parties, we then seek permission from clients to progress with that particular party. So you still have complete control over who will eventually receive that information memorandum document. And I would say we can often be surprised by who the eventual acquirers are for businesses that we market for sale. So it's not always a case that it comes from a direct approach list and it is a competitor. I remember a very early transaction I worked on in my career at Larking Gowen, where we sold a waste transfer and recycling site. And I assumed the buyer would be someone like Biffa or Viola, one of these sort of big trade waste management organisations. And whilst we got interest from those parties, the eventual acquirer ended up being a high net worth individual who'd been identified through our network. He was based in London, keen to relocate back to East Anglia, and he had lots of capital. There's no way anyone would have identified him as a potential buyer for the business for a direct approach. So, in that circumstance, it was the power of our network that helped bring this buyer to the table and help deliver some exceptional deal value to the client. So moving on through the process, once we've agreed our sales documentation and we've agreed who we're going to approach directly and what third-party sources we might list the opportunity on, we need to go and actually make contact with these potential buyers and handle inquiries. So it's not quite Wall Street, but you need to pick up the phone and start dialing. And as I mentioned, we profile the right individuals that we need to be speaking to. So senior individuals at each organisation, generally speaking, they're going to be at board level. So it takes persistence to get hold of these people, to alert them of the opportunity. Once we've spoken to them and ascertained their interest, we'll send through the teaser document along with that confidentiality agreement. And it's only when they've signed and returned the confidentiality agreement that if they're on the approved list, that they then receive that information memorandum document. And it's only at this stage, as I say, that they would find out your identity as the seller. So you've got complete control all the way up to the point they've signed that non-disclosure agreement. If they're on the approved list, then we'll release them the IM. If they've come from our third-party sources, then we seek your authorization first to share anything else with them. As I mentioned, whilst the information memorandum is a really detailed document and it should provide a buyer with sufficient detail from which to make an offer, given we're normally talking about substantial sums of money being offered, those that are interested will generally request some sort of exploratory meeting to ensure they've understood the IM correctly and maybe just make sure they're comfortable with your reasons for sale and things of that nature. So when it comes to the meetings themselves, we're still well aware of that need for sensitivity and confidentiality. So having a load of people turn up in suits at your office or your premises can ring alarm bells amongst staff. So generally, most exploratory meetings with potential buyers will be held off-site. So typically, usually at a Larking Gowen office or maybe at a fellow MHA member firm's office if we need to meet in London or Birmingham or Manchester, for example. And prior to these meetings taking place, we do lots of prep work with the clients in terms of do's and don'ts for the meeting. the crown jewels of the business or sensitive information such as customer or supplier names will probably still need to be held back at this stage. And what we would seek to do with clients where they're comfortable doing so is actually prepare a presentation to give to buyers so that we sort of control what information we share with them at that meeting. Sometimes buyers will request a site visit, and if our clients are comfortable doing so, then we'll try and facilitate these outside of normal business hours. So, maybe hold a meeting late in the afternoon with a view to having a brief site tour once the staff have gone home, or for seriously interested parties where we know that their indications of value are in the right ballpark, then maybe you'll facilitate a site tour under a different guise, like they're from the insurance brokers or something like that. But we'll look to conduct all these exploratory meetings within a pre-agreed time period, because we need to try and get all our potential buyers to the same stage with a view to setting a deadline for indicative offers. We want to ensure we're keeping the process moving along and filtering out who's truly interested and who is out. So once we've had those exploratory meetings, we've answered any initial queries raised from that, we will look to set that formal deadline for indicative offers. We'll ask for them to be submitted in accordance with the information memorandum. So we set out the contents of what we want to receive in any offers made. Again, so it's easy to compare and contrast. So we might have something that looks a bit like this, where we've got a summary of offers going across the top, hopefully maybe multiple pages if we've been really successful, but details about each buyer, and what their headline offer is, etc., etc. And it's at this stage we'll work closely with our tax specialists to calculate probably the most important figure to many sellers. What's the net amount in their pocket going to be after tax, as it isn't always the highest price that delivers the highest net proceeds, particularly if the deal was structured to trade an asset sale rather than a share sale. And Richard Proctor's going to cover that in his presentation next week. But furthermore, there'll be other considerations just outside of headline price that will come into a seller's decision-making process. So, what are the future plans for the staff? How's the consideration being paid? How much is payable on day one? How much is fixed? How much is subject to earnout? And clearly, when we're acting for sellers, we want all or as much of the consideration paid on day one, and we want the price to be fixed. Gives everyone certainty. Buyers, on the other hand, will want to share in the risk and rewards with vendors by some of the consideration being dependent on hitting future performance targets. Generally speaking, most deals will include some form of deferred consideration, but we have managed to agree full consideration at completion on a number of deals in the past. Probably in the current climate, I see earnouts becoming more and more popular because there is that uncertainty over what performance might be post lockdown and post COVID. But the final point on this slide, I think, is the most important, because all of this is negotiable, and so I think in reality the way you can get the best deal and the way your advisor should be working hard for you is if they've got you competitive tension. So if you've been through the confidential process and received multiple offers, then you're in a far stronger negotiating position than if you just got one buyer following an off-market approach. So again, really good example. We had a transaction complete last year, which was significant in deal value, where our client initially received an off-market approach from a competitor, where theoretically, if you're looking at the value of the business, the offer looked reasonable. The structure of the payments wasn't great, though. There was a large amount that was deferred, albeit it was fixed. And as part of that approach work, we helped the client prepare an information memorandum. Again, wanted to present the business in the best possible light. And we were confident that if we were running a competitive process, we could get them a better offer. So in the end, our client, it whetted their appetite, but they wanted to see what was out there. So we went and ran a confidential competitive bidding process. And that job actually completed where the final price was over £10 million higher in terms of overall deal value compared to that off-market approach. So that a significant increase. And again, because we had so much competitive tension, that deal also paid 99% of consideration on day one. So as a PLC buyer, we convinced them that they ought to purchase warranty and indemnity insurance to prevent the need for any of the consideration being deferred. So it was a vast improvement on the off-market offer received, and even that eventual purchaser's final offer was substantially higher than their first offer, because there was strong interest from overseas buyers, other trade competitors, and PE firms. So competitive tension helps in two ways. It helps with overall price, because most buyers won't put in their best offer first, and you can be bullish in your negotiating approach if you've got other offers on the table. But it's also really helpful for negotiating some of those softer side points, like what your consultancy agreements might be going forwards, and what handover period you have to give. So what you really should consider if you did receive an off-market approach is, would you feel confident that you got maximum value for your business? Competitive tension is, in my opinion, how you know that you haven't left any money on the table, because you've fully tested the marketplace. So once your advisor has given you a fantastic selection of offers to choose from, the next really important stage is to pick your preferred bidder and document the deal so that everyone's in agreement about the key terms of transaction. And this is done in something called heads of terms. So what are heads of terms? Well, they're typically a fairly succinct document which will outline the key financials of the deal, the price payable and how it's being paid, i.e. is it all completion, is there any deferred or any earnouts, key assumptions around their offer, what are their plans for the business going forwards, what might their headline due diligence requirements be. And it'll also set out other things such as the completion mechanism by which the deal has been undertaken. So it might be on an assumed balance sheet value at completion, it might be on a cash-free, debt-free basis. It will state whether completion accounts are required or whether there'll be a lockbox completion mechanism, things of that nature. Are they necessary? It's not a legal requirement, or you don't have to have heads of terms, but we thoroughly recommend them. There are lots of things to pin down, and ultimately it helps save you time at the back end of the process with the legal drafting, can prevent email ping pong between the lawyers on certain matters. So having a detailed set of heads that set things out very clearly does help streamline the back end of that process. But in terms of, are they legally binding? Well, no, apart from a couple of points. One is obviously confidentiality is beefed up further. So even though there is an NDA in place, when it comes to the due diligence process, that buyers are going to be getting access to much more sensitive information. So the confidentiality provisions are beefed up, and the buyer is going to be wanting a period of exclusivity in which to conclude the deal, because it's at this stage, the buyer's starting to start incurring some professional fees and costs, and so they don't want you speaking to other parties at this stage. And it's at heads of terms really that the timetable starts to be dictated by the buyer, and you'll see the legal advisor start to play a key role in getting the deal over the line. Up to the point of signing heads, we've had a lot of control around the pace of the transaction, and we can be, everyone's best mates. We can be quite bullish in our negotiation stance, but once heads of terms are agreed and exclusivity has been granted, then the emphasis does then move towards the buyer, and it's on them to complete their due diligence and complete legal contracts, which brings me on nicely to the next stage of the process. So once heads of terms have been agreed, the buyer will start to form their due diligence procedures, and they'll also look to start preparing the legal contracts. These can be run simultaneously, which is why they're shown simultaneously in our flowchart, but generally they'll start with a little bit of due diligence first and foremost. And in terms of what you can expect from due diligence, well, typically a buyer will want to do financial, tax, legal and commercial due diligence. They'll want to validate and verify the information that's been presented in the information memorandum. They'll want to check that profits were properly reflected, ensure that balance sheet assets aren't impaired and there's no understatement of liabilities. They'll want to look at your key contracts and maybe look at things like change of ownership clauses. They'll want to look at your employment contracts and your compliance with laws and regs. So there's quite a lot to go through. And in terms of how that process works, you can probably expect a third-party accountant to be doing the financial and tax due diligence on behalf of the buyer. The lawyer will tend to do the legal DD checks, and the buyer may do some in-house commercial work. I have seen it in practice where a third party has been used for commercial DD. So I mentioned earlier a transaction where a buyer wanted to validate the level of synergies. Due to the sensitive nature of the information being shared, there was a third party used for that, as it was so confidential. How invasive will it be? The answers vary. Unfortunately, you can expect to get a fairly lengthy information request and questionnaires covering all areas, and you can expect that you're going to get a lot of follow-up questions too. So this is where it really pays to have gone through that sort of preparing your business for sale and pre-sale due diligence exercise. So you've done as much of this work in advance, because this is a very time-intensive process. So if you've done as much of it up front, it'll help save you time at the back end of the deal. And in terms of how your advisors can help, well, we can help ensure that the information is sent across in the right format. Where appropriate, we can help put a block up that certain key information might be held back until later in the process. And as I mentioned, we act on the buy side for clients, so we can see whether something might ring alarm bells, and perhaps if something could be presented in a better way or explained in a less controversial manner. But all in all, it's thorough, it's time consuming. So if you can prep up front, it really does pay out at this back end. So the main legal contract in relation to the transaction is most likely to be a share purchase agreement, or if it's a trade and assets deal, it'll be something called a business purchase agreement or asset purchase agreement. They're sort of interchangeable. Most deals are done on a share basis, primarily because it's more tax efficient for sellers, and it can be easier from an administrative perspective for buyers, as they don't have to reassign all the contracts to a new entity. But as I said, Richard will touch on some of these tax aspects next week. In terms of who prepares the legal contracts, well, that'll be the solicitors acting for the buyer, and that's always the case. These documents are generally in place to add protection for the buyer in terms of what they're acquiring. What can you expect? It's going to be a lengthy document. They can be 100 pages plus. There'll also be lots of ancillary documentation, such as consultancy agreements, directors' resignation letters, board minutes, disclosure letters. You do sign an awful lot of documents on the day, that's for sure. In terms of which firm of solicitors you should use, first of all, you need to use someone that you can get on with, and perhaps someone that you know from previous work is a good place to start. But whoever you use, make sure you use a corporate specialist. Don't use the guy down the road that helped you sell your house. Selling a business is a very different beast. You can guarantee that the buyer will be using a corporate lawyer, and you need to ensure that your corner is being defended and that you can sleep at night post transaction. But we are really lucky in East Anglia. There's some really strong corporate lawyers and teams that we could happily make recommendations if you didn't have anyone in mind. I mentioned that legal contracts were long. Probably the reason for this is the biggest chunk of the contracts are things called warranties and indemnities, and these are effectively statements of promise about the business that you're selling. So they're there to protect the buyer and flush out any issues that may not have come to light in their due diligence. And if you give any misrepresentation about any of these warranties, then you do risk being sued at a later date. The protection from the seller's point of view is something called a disclosure letter. So all the warranties are fairly standard. It's quite difficult to get warranties removed. But if there's a warranty that you couldn't give, so a standard warranty would normally be that there's no employment claims, for example, but you did have an outstanding issue of an employee, then the disclosure letter is your opportunity to inform the buyer about that issue. And if they still go ahead and complete the deal knowing about that, then they can't sue you at a later date. So a good corporate lawyer will ensure that those warranties and indemnities are as watered down as possible, and where appropriate, disclosure has been made to protect your position. So once documents are in agreed form, it's then just the formalities of completing. And this will generally mean you turning up to your lawyer's office to sign originals of the various legal documents. So that's been a challenge in COVID, and we've had experiences of documents being witnessed outside someone's window or outside someone's car bonnet. But certainly on the day, you just need to make sure that you've got a good pen, as there'll be an awful lot to sign. Now, when I first started in corporate finance, completion meetings looked a lot like this, where both buyer and seller and their respective advisors would get together, good picture opportunity, and everyone has a bit of a jolly afterwards. This still does happen on occasion, but in most transactions, you've probably got buyer and seller in completely different parts of the country, and so logistically, sometimes this can be difficult. So it's more common for completions to take place electronically. So you just turn up to your lawyer's office and sign the various documents. But clearly, where possible, it's nice to go out and celebrate with clients, because once you've signed and the flow of funds has happened, then all the hard work's been done. And it's nice to go out and celebrate the work that's been done to this point. So you could be forgiven that, thinking that once the money's in your bank, that's the end of the process. There are some post-completion matters to attend to, some of which we'll be covering in more detail next week, but I'm just going to touch upon one of the main things that you need to consider post-deal, and that's completion accounts. So why completion accounts sometimes needed? Well, one of the most common things that tends to need to be done is completion accounts, because the deal might have been based on certain assumptions around the net assets at completion or the working capital at completion. And so some accounts need to be prepared at the point of completion so we can finalise the sales price. And it's a bit like going through a mini year-end process. Generally, one side would prepare within a couple of months, with the other side having 1 month to review, so any balancing payment or attention to be made. And generally, the buyer would draft them, but we've seen roles reversed, and we often try and negotiate on this stance when we're selling, because I think if, as sellers, we can present the first draft completion accounts, it gives us the opportunity to present those in the best possible light and maximise proceeds. I mean, there'll also be periods of consultancy for many sellers as part of the handover to the owners, but as I said, some of these other post-completion matters will be covered in our final session next week. So in terms of content today, that's it from me. I appreciate there's a lot to take in, so there may well be some questions which I am going to load up now. And as I mentioned, all the questions are completely anonymous. So if you do have any questions that you'd like to raise, only I will be able to see them, and I'll happily read those out for people. So I've got, okay, I've got a question here, and the question is, how long would the sales process typically take? Now, I would say typically that the sales process will normally take between 6 and 12 months. Sometimes it's shorter, sometimes longer, but generally speaking, you need to allocate probably up to a year for the sale of the business, and then factor in some time for consultancy post transaction. I had another good question here. It says, how much does the sales process cost? Well, we can be entirely flexible when it comes to fees. Generally speaking, we'll work on one of two bases. So we'll work on a primarily contingent fee basis, where we share the risks and rewards with our clients, and most of the fees are payable on completion of a deal. So we'll get some stage payments along the way, and then a success fee, which will generally be based on a percentage of the sales price rather. And in some circumstances, clients might prefer us to work on more of an hourly rate basis. So we're quite flexible and confident working on either basis. We tend to like working on a success fee because we back ourselves to sell businesses, and it tends to be, we tend to be more aligned in terms of our aims and objectives of our clients. So we like working on that basis where we can. Are there any more questions? Let me just check. So I think that is it for the time being in terms of questions. As I mentioned, I hope you found the webinar helpful. My contact details again are here if you'd like to reach out and speak about any questions that are more personal to your business. We do have our final webinar of the series same time next week, where we have Richard Proctor from our tax team speaking about the taxation considerations on a sale and how we can structure these to be as tax efficient as possible. I'm also really delighted to say we've got a Q&A with a recent client with whom actually went through the process with us and sold in February this year. So if you haven't signed up for that, please do so. And that's all from me for now. And that just leaves me to say thank you for watching and best wishes to you all, and stay safe, everyone. Thank you.